Welcome to the new Barbarians Podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Millikan's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Hello, everyone. Welcome to episode 30 of the new Barbarians Podcast. Today is Wednesday, July 30th. The podcast will hit the platforms later today. Today we are joined by Michael Magoulias. I hope I pronounced that right. I've known Michael for too long not to pronounce his name correctly. Michael is the commercial director at SSRN, the Social Science Research Network. It's a subsidiary of Elsevier, which is a French company, I believe, and I'll let Michael correct me with any mistakes I make with this intro. I first met Michael when I was searching for better ways to scan SSRN for new and novel ideas from academia at a previous employer. In other words, I was looking for ideas to test in the quantitative research space from academia, which is a fairly common practice. A lot of the people I've worked with over the years are actually from academia, and I can assure you that there are plenty of ideas that have come from SSRN and academia that are producing alpha for investors at quantitative hedge funds. So it'll be fun to talk about our long history and we'll dive into the products that he designed for that purpose, as well as our own long-term collaborations over the last 7+ years. Welcome to the show, Michael.
Thank you. Thank you very much, Bill. Really appreciate it. I've appreciated all the conversations over the years. You've given me more targeted insights than I could have hoped for. And you've also afforded the opportunity for me to do my favorite thing, which is talk to subject matter experts. Actually, Elsevier is part of a large company called Relix, RELX, which is, I think, the 7th largest company in the UK. It's an Anglo-Dutch company that has a number of subsidiaries throughout the world. So it's a major scientific publisher, but it also has LexisNexis in the legal space, big risk business as well.
Cool. Thank you for the clarification. I think I did know most of that, at least from previous conversations. And then just to quickly talk about quant performance recently, last week, short interest was the big performer. I think a lot of the news has been about meme stocks, and the short squeezes just caused outperformance with that factor. Momentum was way down. Again, I don't think that these are that significant. I think short interest may have been statistically significant, but momentum is not, even though it was down 4% on the week. And then I'll take a look at today and yesterday, but that was the big news, really, just the short squeezes that are caused by Redditors and people on chat rooms and things like that, which is one of the best examples of the new world we live in. And I remember when I first read about that, I was like, oh, that's pretty smart. I guess it's still working to a degree. I don't know to what extent everything gets coordinated or who kind of runs these Reddit rooms or anything like that. And we're free to speculate, and Mark, I believe you're on mute, but I was going to pass it along to you anyway.
I'm going to ask you a question. Thanks for that. You're saying that it still works, meaning still a force driving factors in the marketplace.
Yes. So it's funny, when I talk about the most traditional factors, value, quality, growth, those are factors we've all known about for like 100 years. That's what a lot of the textbooks talk about. It's the most intuitive thing. You want to buy companies that are cheap. You want to buy companies that are growing and will produce more cash in the future. And you want to buy well-run companies that aren't taking on too much debt and risking blowing you out as the equity owners. You don't want to have too much debt on a balance sheet, for example. These are pretty straightforward, obvious things. I don't want to be like pedantic about these beliefs. They're actually just my training and upbringing just makes me repeat that over and over. But yes, factors will always work because they recognize things that humans have identified as good reasons to make decisions, like buying good stocks. That's why factors work. And then the short interest factor itself, I think we only really see these crazy outperformances when there is like an active short squeeze in the market. And over the last couple of years, like the biggest short squeezes that we've observed have been these like meme stock things. And those are very difficult to predict. I think they're becoming easier to identify, at least after the fact, or maybe having some idea of which stocks are at most risk of this like newer phenomena. Short squeezes have been around for forever, but the meme driven short squeeze is the new one, and it led to some pretty famous blow-ups. I'm sure you can elaborate on that even more than I can, Mark.
I think Bill's, the fact that I was at Credit Suisse in 21 and saw crowded shorts, squeezed, Reddit, Wall Street Bets bandits were going after, I forget the name of that they put out a $4 billion SAC spin out, put out of business. He was a high value client. Everyone's like, we got to get this guy. He's smart, he's good.
I'm not sure if it's pronounced Archegos or Archegos.
No,
that was the
Bill, that's even later. Archegos is even later. I'm talking about Nick, I think his name was. And he got put out of business first by being short squeezed in March of 21, and Archegos a couple months later. This is going to be a failed podcast if we don't bring up links C.S. Lewis to factors that are persistent, are tied to real world star qualities that are enduring. So whether we can tie that to Aslan or not, I'm not sure, but I'll be disappointed if you can't. That's what Bill basically is alluding to when he said it's not just that it's quality, it's that it speaks to real world attributes that are meaningful. All right, well, folks, what I do now is kick into markets. We're going to dive into a topic here, as Bill said, with Michael, on the new use of data. I think of you and your firm, Michael. I think of the quote by William Gibson that the future is already here, it's just not evenly distributed. I don't know if given our brief engagement, I know that you're well read and you obviously are familiar with that quote.
It resonates very strongly.
And I look forward to, so we're going to bring out some data here that we think, especially in time series, we're all focused, on the near term. We're like goldfish, don't have the ability to take on pattern recognition too often, blade attention. And so I'll do some market stuff now, and then we're going to go back and have you, Bill's going to go into some of the use of your data, some that we've obviously used over the years. July 30th marks the day when the January 23rd executive order by Trump on the President Working Group get the OCC, the SEC, the FDIC, the Treasury, CFTC, all together to bring a digital asset plan. It's coming today. If nothing, the president has followed up on all of his executive orders on time. And I think that the legislative impact from Genius Act, the President's Working Group piece that's being dropped today, one big beautiful bill, all very impactful. This is not a booster for Trump. It's not a warning. It's a signal that hopefully in the next few minutes, you'll see what the market has already done in anticipation to absorb we see as a tidal wave of liquidity, regulatory onslaught markets that'll leave many behind with some new winners. So here we go. We start out with a scorecard month to date. Snapped this morning, a couple hours ago, Michael and Bill. Coin, oil, commodities leading. NASDAQ, the third, everything else, a low single-digit midget. And we think this is a nod to the inflationary nature of the one big beautiful bill, of behind us, the eventual price increases that come with the $300 billion of levies that are being paid to the U.S. government by everybody from the suppliers to the manufacturers to the consumer. That's not going to, it's not anything that's not going to surface in price. The next one we go to is about pattern recognition. Similar thing we saw last week. Bring it up because not everyone appreciates the fact that gold, Bitcoin are leading this year. Gold has, in the last 5 years, outperformed non-U.S. stocks, just underperformed NASDAQ and S&P over a 5-year basis. But we think, as a store of value, both gold and Bitcoin's performance this year, a regime shift, will show you a graph that we don't think anyone else has shown, indicate the level of debt liquidity that is still to come in the next 9 to 18 months. So I'm going to go through the ETFs. This is going to be in a Substack, but it's basically as when we talk about the Genius Act bill that's coming, I haven't had a chance to really talk about it too much, but the stable coins that are coming, it's for banks. Banks are set up at the dinner table for this because they've seen the demand that the Bitcoin ETFs up top here, only around for a year and a half. The other major asset classes have had 15, 20 years of exposure. But when we look at the AUM, the 11 ETFs, most of it is in the BlackRock IBIT ETF, as much AUM as BLD and IAU. ETFs out for 20 years on an asset that's been around for 5,000 years. Rate of adoption, Eric Balkunas at Bloomberg said, is underappreciated, unprecedented. But back to incentive structures, BlackRock's not doing this because they're nice. They're doing it because the fees are higher. They think that the performance of Bitcoin can go in their portfolios, billions of dollars of client assets. So this is just the beginning. So that's the point about performance. And now, why we said was about legislation. Genius Act, one big beautiful bill, throwing down the regulatory shackles. Who's up? Robinhood. So, Michael, you were talking about editorial quality and how these firms and broadcasters are thinning the ranks and trying to rely on folks like you for content, and how people are more short-term focused. He's more short-term focused than traders in Robinhood. Trading volume is up huge. They're trading at a 70 multiple because the street thinks that they'll be able to more business with lower regulation because they've done the dopamine hit and gamified trading. They're almost like the Wall Street bets, a arm to pull down like a slot machine, monetize that interest the more. I mean, up almost 200% in the year. And then Circle is up ahead of the Stablecoin Act. IPO was in June, one of the most successful IPOs, a digital asset native company. Coinbase, we all know it well, for $100 billion, and to benefit from all that. And then you have the other digital assets that are in the presidential executive orders for digital asset reserve, XRP, Ethereum, Cardano, ADA, and Solana. So is when you talk about bill reversals, momentum down, and short covering, and we got Citibank in here. The reason it's in is because it's trading below book, and everyone thinks that there's just going to be a lift in the entire sector. So why buy JP at 2 times book or wherever it's trading? We buy the discount. Yeah. It's a total reversal. It's risk on. You don't call it a garbage rally because I think some of these assets are worthwhile, but there's definitely a shift, and we're seeing it here in the names. Here's the cautionary tale. Big beautiful bill. It extends the habit since 1985, imposing debt ceilings, borrowing from civil servant pensions, to pay for the mandated expenses they can't meet with more debt. Started in 85, but look at the stepwise function. Like, if this was a stairwell in a New York City apartment, it wouldn't be the code. Look, for the first time, debt ceiling is well beyond GDP, the green line. So this one graph, I think economics class could study because there are fewer recessions since 85. So you had the double recession of the 90s, 2001, 08, and then the cup of tea recession in 20. The reason? Because we paper over it with debt. We just did it on July 4th with the one big beautiful bill again, $5 trillion ceiling. Go have at it. Guess what? It'll be raised again. This is why the regulatory shackles are off, because Trump has to grow his way, our way, out of this debt load, because they don't want to stop this train. That is why folks like you with SSRN, we need to go into that pile of millions of papers. We have to have people who can curate and direct us and put a short list of things that are helpful to change models, because what made you money in the last 10 years, not going to make money for you forward. There's a lot more to talk about, but I'm going to stop there.
Cool. So we did segue into something specific that was spawned. Well, first of all, the crypto stuff is crazy, and Robinhood. And I remember when it seemed like overnight maybe it was insolvent, but I'm sure no one else does.
But, what's $1 billion shortfall between friends when you're trading one-day options helping out America's youth?
No comment. Definitely no comment. We're trying to appeal to that audience with this very podcast.
Yes.
But, what I will say is that there was a little footnote with the Wolf Note that I took a look at that, research shows that this setup strongly raises the probability of a correction. The expectation is that the short interest factor will revert to long-term equilibrium. And what's interesting about factor investing is, a lot of people have believed, especially like strong econometricians, that, factor rotation isn't something that can be done systematically. But this is one of those nuances where, with a 2 or 3 standard deviation event, a statistically significant move in a group of stocks, you have to read through the lines a little bit to get there and reduce it to that. But it's basically like these crazy moves in these stocks. And in this case, they're crappy stocks too. Like when you observe this, it's kind of a binary outcome, right? Like all of a sudden these crappy stocks rally, and I think the expectation is that they should come back down to earth, or at least all the stocks with those similar attributes should not behave similarly. So a lot of stocks have short interest in them because they are betting against bad companies. And then you have this uneconomic thing, which is sort of organized short squeezing crappy stocks to outperform. Which is very uneconomic, and it's just a very interesting animal. But like I think the takeaway there is, you don't bet on the short interest factor now. You probably missed it, and in fact, it's going to reverse against you. So that's just a little tidbit about the factor space and research, which brings us to Michael. Now I am motivated to do a query for papers highlighting the short interest factor, and in particular, there have been a lot of papers written about these like retail short squeezes. So the GameStops, Kohl's, Open Door, Beyond Meat. What was the?
That was the acronym.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support. Okay, yeah. Sorry. And so, yeah, I do need to do a query for those types of papers and kind of summarize this. That would be a pretty cool outcome of this, maybe a short note that just discusses short interest and what it is and how you can bet on it systematically. But, I gave the introduction to Michael. I guess, Michael, feel free to give us a further introduction into your background, and then Mark and I will start asking more questions.
Sure. Well, I've been in academic publishing of one kind or another for over 30 years. My first job, believe it or not, was on British Vogue as a copy editor. They had a writing prize for young writers, and when I wasn't quite sure what I wanted to do, that seemed like a good option. And then that just led to working in academic journals and working on reference books. I had a stint as a journalist covering the pharma industry, which relates to a lot of my later thinking about how research works in the real world. And I was publishing director of The Lancet for a while, helping to launch new Lancet journals, ran the journals division at the University of Chicago Press, so got some experience of being in a major research institution, and then have been at SSRN for about 7 years. So looking at the early stage research, whereas in the past, everything I'd worked on had been firmly in the world of peer-reviewed research, which is the most rigorous and the most trusted. It's gone through a great deal of review by subject matter experts. Disciplines like economics and finance, there are certain norms that make it very different from medicine, for example. And I think when we talk about research generally, there should always be the proviso that every discipline is different and has different norms and different needs. And Mark had mentioned the dimension of time, which is really, really important in the context, as you know, of investing and thinking about finance and economics. Little changes, little bits of information can have massive effects in a short amount of time. And actually, Bill was the one who gave me one of my great kind of marketing lines about SSRN, which is that, you guys are leading indicators. And that's because SSRN gets early stage research before it's been published in a journal. And that is an accepted norm in economics, in mathematics, in a lot of computer science. They still have peer-reviewed journals, but the length of time from research to publication makes it very difficult to act on.
You weren't supposed to share that little nugget. That was something Bill and I were going to try to create our own factor about, but I guess cat's out of the bag now.
No,
That's all right.
I'm smiling to myself a little bit because I almost do have the urge still. Like I've been trained by very paranoid people that have concerns about IP slippage, and I'm sure. I guess when you first met me, it must have been right after you started there too, because I want to say that's
Yes.
around the time we started talking. I'm sure that I was like, never tell anyone that you're talking to me, and like I don't exist, and but at the same time I was telling you, peer reviewed to me means it's gone. Peer reviewed is great. Like that's actually a good thing for a resume. I think it proves that you've done very good research. It's been accepted. But in my community, that also means you can't make money off of it anymore because everyone's known about it for 2 years when it hit SSRN. And there was a paper that I'm sure we can even highlight and link in the chat, but it sort of proved what I told you too. And I forget what its title is. I can't believe it's like the seminal paper. I'll tell you before the show's over, but sorry for interrupting.
No. Okay. So one of the interesting things about SSRN is it was created by economists before the World Wide Web fully launched. And it was very much a way of capitalizing on digital technologies to meet and really exceed expectations in the traditional form of research communication, which up to that point happened in usually conferences, face-to-face meetings. If you're at a business school, you tended to have a bigger budget than in other departments, so you could travel to other business schools and say, so this is the paper I've been working on so far. This, or you sent someone a letter with it. Digital technologies meant you could defeat time and distance, and you could put it on a website and people could go and look at it. And that was a really interesting early signal about how academia could benefit from the internet. Of course, as time goes on, you start seeing unintended consequences, other ramifications that might not have been clear at the beginning. So one of the ways I think about this whole area of, not just academic information, but all information is, we might have solved a scarcity problem with not just abundance, but overabundance. And therefore, that's going to create another scarcity problem, or really, I think, several scarcity problems. So one of them, obviously, we know is attention and time. As we have more papers, and basically 3 million peer-reviewed papers get published every year. That doesn't include all the papers that are submitted and maybe not accepted for publication, or the working papers that are available. So that's obviously an amount that no one can really deal with individually. So you need more technology to try to separate the noise from the genuine signals. And I think another form of scarcity is the notion of quality has become a lot more vexed, I would say. how to determine, especially in a world where there's so many proxies, how can you make sure you're using the best proxies? How can you more rapidly use those to get to what you need? Right now, of course, we're seeing AI. A lot of people are launching tools that will help with that type of process. So that's, kind of the genesis of SSRN, and how, in a very short way, how that led, from roughly 1992, 94 to our conversation today.
Cool. And I did find the paper. I was just trying to figure out what year it was. I think it was 2012. But while I'm trying to pull that up, I'm going to share something that I actually created and posted on LinkedIn a while ago. Sorry for the delay. So the paper was called "Does Academic Research Destroy Stock Return Predictability?" By McLean and Pontiff. And, I basically converted the words into this spreadsheet that, I think it's a very simple analysis, but basically it's saying years following the publication of the research on something like SSRN would be 0. And then the percentage of alpha remaining from that idea would be 100% before you tell anyone. And then after 1 year, it's 65% is left. After 2 years, 50-ish%. And then it's, below 40% in 3 years. And then, it kind of diminishes to what is probably considered, an idea that's not worth pursuing at like 20%. Of course, if it's, you found the new value factor or something like that, this is a little bit nuanced. But assuming these were good research ideas to begin with, and the biggest criticism people ever have for academics and quant research is, poor representations of reality, and the most common one is not having transaction costs incorporated in your model. You can make a lot of money if you don't have to pay for your trades. But I believe the papers that these authors used were, well-regarded ones. They were good papers that actually demonstrated alpha returns from a hedge fund's perspective. And so that this kind of illustrates it. Like 2 years after you publish something, pre-publish on SSRN, you may get your recognition in the community with peer-reviewed journals and things. But, most of the alpha with that idea has been traded away already.
Right. That's it. So I think if you flipped that curve, what you'd have is a pretty good representation of how the research is socialized through the community, especially in the academic community. But what you would see is it getting cited for a long time at a fairly high level, right? Initially, and then to compare citations with downloads. It was kind of funny hearing about Robinhood and GameStop again, because when the original story happened, was it 2020, 2021? I've lost track of time, but I remember my son, who was a gamer at the age of 14, the first time he had some kind of real understanding of what he did was when he said, "Hey, Dad, have you heard about this, Robinhood and GameStop thing?" I said, "Yeah, some authors just posted a paper about it." What was fascinating about that, it was a very good paper, but it was created in quite a short period of time. And so I think of this kind of research that we get as research as news, because it is timely. It has a great, I think, Goldilocks aspect of being very timely, but enough time has been put in to get things right and to be thoughtful. And what I'm kind of interested in hearing your ideas about is increasingly, I think, as our whole economy is more dominated by like non-banking institutions. I've had more discussions with people in those types of enterprises, and they're very used to just looking at data or buying data. I had someone say to me, "Well, we don't really get any journal content. Tell me about the world of journals." So this is from an organization that's responsible for trillions of dollars. So I gave it a little intro to journals, but it made me think. What I find really interesting about some of the language you've used, Bill and Mark, is the notion that ideas have this value, and ideas are different from data. right? Obviously, you'd want ideas to be driven by data, but there's something that goes beyond the data to create an actionable idea. And I sometimes think in our society, which is so now dominated by data-driven and evidence-based language, that we kind of forget that some of the greatest value is simply having ideas that might prove themselves empirically, but it's the core idea itself that could be a potential game changer.
You're on mute, Mark.
In that thread, we were talking in our own green room before the launch here. We were talking about C.S. Lewis, about Narnia. That's a theme about, me, Besant, opening the door to a whole new bunch of buyers, stablecoin. Then you said C.S. Lewis was an impact on you. Well,
yes.
What he did, and C.S. Lewis is just, he's brilliant on many domains. He liked the story. So I think for me, the idea is the exploration. There's an excess of it, meaning you can get lost in the sauce. What he does, I think, and would create characters with, as we said, with Earl Tolkien, Welsh author I keep forgetting.
You were mentioning Dylan Thomas, conversation.
They'd all get together in the afternoon for a pint at the Lion and Scepter, or whatever club in Cambridge pub. They would talk about characters and the character and the story of the person, the background, and then the story would come from that. And I think of in that to the investment side or the business side, that's kind of what also part of another great barbarian with our theme, Bill Edwards Deming, who just revitalized Japan after World War II. He injected psychology to his 4-pillar model, understand systems. I think that's what ideas do. It's not one thing, but it's exploring. Bill brings a very strong empirical background to our relationship. I have a statistical one, but to explore more. And the combination has been excellent and really fun to watch. I think your SSRN made a submission almost 10 years ago. Be on that platform, help that evolutionary process, the feedback from people, et cetera. So tell people how, if you submit something, when you said that decline in alpha flipped on its head is an expansion of exposure.
Yes.
How does that help people who submit papers beyond, because we just look at the negative alpha. Now, Bill said, is there a residual benefit to the people?
Yeah, so research has a surprisingly long tail, and I think it's been underappreciated, the extent to which a lot of foundational papers stay relevant for a very, very long time. Sometimes, some people will say they stay too relevant, and they're cited to the detriment of newer scholarship, because it's assumed that, well, if you're going to write about this topic, you have to talk about Eugene Fama's paper, right? And so, it just creates this ongoing massive number of citations for Eugene Fama. The early career scholar doesn't get as much visibility. SSRN helps with that because a lot of it is the massive network effects. For a long time in the world of the web, it was just exciting to say, hey, I'm going to create a website. I'm going to slap some papers on it and build it and they will come. And quickly, we discovered it doesn't work that way, that there are audiences that coalesce naturally amongst and within communities. And to be really powerful, you want to be in a community or network that has these large network effects. So I think, early on, SSRN became the place you needed to be. For, the main, we are very, very interdisciplinary, but the historical core was economics, finance, accounting, and law. There's the subdiscipline of law and economics that really, I think, drew in the law people early. And that tends to be still where most of our revenues come from, because we're very unusual in having a commercial model. There are about 60 early stage research platforms. All of them are funded philanthropically and don't have a commercial aspect to them. So we have a freemium model where things are basically free for individuals, and then at an institutional level where we're really trying to drive awareness and impact. Increasingly, there's this notion of societal impact for research that we can talk about later. Things like how many downloads you have on SSRN. What can we tell you about who's doing the downloading? Are your papers getting mentioned in the New York Times and the Guardian, cited in Wikipedia entries? These are becoming really actionable data points when researchers are being assessed by their institutions.
So I think you had some slides. I'm actually going to share one right now.
Please do.
Because that having a website takes time and effort. And what you're saying is like what Bill and I do with Substack. We got the idea, and I don't want to really maintain a back end. I have an idea. We publish on Substack. You're saying on the blog, that's not research. But for the higher end research to be part of this network, these are some of the metrics on distributions that you guys have.
Right. Yeah. So we send out millions of emails every year, and we have quite good open rates. What we do to to keep the lights on, or we create e-journals for university departments, business schools, law schools, research centers. So organizations that produce a lot of research but might not just have the bandwidth to create their own journal. And so we help them with that function, but we also do a lot to push it out. So it's not a passive archive. We send out emails of the latest research for that institution, but we'll also put each paper into an interdisciplinary topic-based e-journal. If you're talking about patent law and how that could affect vaccines, that'll go into a pharmaceutical e-journal. We also will promote heavily on our social media accounts, which really drives a lot of valuable usage, not least from the media community. So as we've found that a lot of original reporting is becoming more and more difficult in today's environment, journalists are relying increasingly on places like SSRN for story ideas. This really, really became a fundamental reality almost daily for many people during COVID. You have a global pandemic, people are dying, everyone wants some information about what's happening, right, as soon as possible. And so a lot of that came onto platforms like SSRN. And we realized, okay, this is a type of content that obviously has an immediate impact on human health. You're not going to send someone to the emergency room if you have a bad paper on medieval French poetry. But if you get something wrong with COVID, that's going to be highly problematic. So we created a whole new editorial workflow for medical content. I'm
just looking at this, Michael, here as far as feedback for anyone, especially something like healthcare, about who's doing it from a demographic standpoint, from an industry standpoint, obviously a geographical standpoint. I mean, that's crucial for...
Right. And so one of the biggest innovations, so a lot of people tend to, one proxy is looking at downloads. So almost everyone reports downloads, and that's viewed as a proxy for readership and impact. But it doesn't really tell you all that much. I mean, you can have a geographical map and say, okay, people in Australia, people in China, they read the paper. But one of the innovations I made that's been incredibly well received by people in academia, but also in the corporate world, has been to look at all the usage we're getting from IP addresses and translating them into named institutions. So you can say that this particular paper about how COVID is likely to affect the economy, well, so this was downloaded by the European Commission 20 times over the space of a week, or looked at by Goldman Sachs and so on. So you start getting a sense that you are impacting significant players, and not just in academia, but outside. And so this notion of societal impact is, in the UK, for example, this has become a major criterion to decide how much money universities get from the government. Can they demonstrate societal impact? And it's a fairly wide notion that it isn't heavily prescribed what counts. So in a way, it's up to researchers and their institutions to define societal impact. And we find our numbers work quite well. We've been working with the Financial Times for a few years on looking at the societal impact of papers authored by people at business schools or economics departments. And for them, the Financial Times defined societal impact as, was it really being downloaded by people in the corporate or government sectors? So, it was like, we don't want to know about academia. Yeah. We want to know, that's where the rubber meets the road for them.
That's like, golf commercials appeal to a certain demographic on the corporate, on the higher spend area. And that's, people want to know what's behind the IP address, and you guys have done that. And as the point I like about, and I've been using SSRN for years, and I'm amazed still, to, I think the unwashed, as I like to call folks, just don't know about this. It's in industry. And the reason I find that fascinating is, the table I showed you, the other type of large repositories of data, some are metadata, some are just links. You have Sweat, the depth of work where people drop it and they stay with it because they want it to be reviewed. They want to see what the feedback is. That's what makes it a network. It's not back to Robin Hood, it's not a one-day option for a dopamine hit. I mean, people are committed to this. And breadth of discipline, saw Bill pull out when he was from his AI effort. It guided us on how everyone was wrong at the beginning of the year about markets.
I mean, Bill has some great papers on the site, and actually those represent an interesting point about what we like to get. It's not strictly papers that are going to be destined to be submitted to a peer-reviewed journal. We love thought pieces, white papers, book chapters, anything that, and I think in the world of finance, this idea where we can serve as a bridge between academics like Cam Harvey at Duke and practitioners like yourselves, that's incredibly valuable for a number of different audiences. And, Bill's papers have this amazing methodological aspect to them, especially when he's talking about the various AI tools that can be used in optimizing a portfolio. These are real world discussions that you don't often get in a lot of academic discourse.
Well, I love compliments, so thank you. And
But Bill, do you like compliments as much as movie quotes? I think that's a close second.
Movie quotes maybe are a little bit better.
Because I got one for you here on ideas versus practitioners. Michael Keaton, I think that's his name. Before he was Batman, okay. He was in Night Shift. Henry Winkler.
Yeah,
he was an idea guy. He had an idea of, said, put the mayonnaise in the tuna fish can. Get easy. and then he goes, no, wait. Feed the mayonnaise to the tuna fish. He was an idea guy, and I think we're not talking about those types of ideas, Michael.
No, but
I do like that. And I also, one of my favorite movies is Mr. Mom. That's he's a crazy guy who went away for too long before he came back. I forget what that Academy Award movie was, Birdman or something like that. But anyway, I interrupted you, Michael.
No, I don't think so. But actually, I want to make some kind of C.S. Lewis connection, even if it's a bit of a stretch.
Please elevate the conversation from Night Shift.
No, but he was a Platonist, and in the world, in Lion, the Witch, and the Wardrobe, and then at the very end.
Hold on, stop on Platonist. I read that, or had that book read to me by Miss Tucci in 5th grade, every class at the end. But tell me, Platonist?
So in the sense, so Plato had this idea of ideas being the true reality, but it's a reality not represented in this world. It's outside of this world. And what is on this world is just pale reflections of these ideas. So like we see horses, right? But in the outside world, there's the ideal perfect horse, and everything else is a kind of pale, imperfect reflection of that idea. And I think, that's Plato was fundamental in the history of mathematics. So, there's always been this discussion about, is mathematics representing reality, or is it just an abstract representation of reality. And I think C.S. Lewis had a great way of combining those two. And you see it at the end of the last battle, where people are basically in the afterlife and it's heaven. And to me, it's actually one of the few genuinely persuasive ideas about what that could be like. And like he combines the best of the real England that the kids knew with this world of Narnia, which is like more like the ideal world. And I think that's ultimately what a lot of research is really trying to do. How do you match the real with the abstract models and the data you have?
And like C.S. Lewis in 1950, it was very common to have children shuttled to the outskirts of London. For the adults there were, say, benefactors. They weren't really around. The kids were allowed to explore, almost forced to explore, yes. And that's when invention happens. And I think we're in that period now, financially, theologically, exploring because of the problems that we talked about with debt and basement and distortion in markets. That's why people are reaching for the closet door, I think, for new ideas.
Well, I think one of the things that I find fascinating about the moment that we're living in is the extent to which our world is defined by finance. You know, I think in the past, people might have thought of politics and Wall Street and technology as separate entities. I think my sense is just we're increasingly living in a mashup of all three, and finance might well be the defining one, between the other two. So one of the benefits of just reading, I just love to read the research. That's why I'm in publishing. I just love reading. You know, it began with C.S. Lewis and it's continued. And reading the thinking that you and your colleagues are providing about, Bitcoin. Like when I first started, I realized, okay, I need to understand crypto and blockchain. And there were great foundational papers on SSRN that really help spell things out.
And in fact, about hiding in plain sight, his name is Michael Ang, a BlackRock quant researcher, Andrew Ang. His team did a paper in February of 22, published it in April on your site about Bitcoin's diversification benefit. And I had done work, found his paper. He had talked about the bliss moment. He said there should be, their data suggests an 86% allocation to a balanced portfolio, just mathematically, because so strong was the diversification benefit. Point is, it was hiding there, and then he pulled it when BlackRock did the ETF because they said, no, bring that in-house. So that, Michael, I think is one of the, and to Bill's point, there's stuff out there, and you need people like you and Bill to curate it, find it, and an opinion about it. It was there. This guy is a pro. He cited it. He said it. Then financier, to your point about finance being so important, Larry Fink weaponized it and said, I have an idea, which is the theme of our topic. I'm going to weaponize it with an ETF. And we saw, we're going to create the fastest to $50 billion, $100 billion ETF in the planet by a factor of 7. And it was on your site. The idea was first on SSRN.
Well, that's a great example of societal impact right there. Larry Fink doesn't need, to use.
Yeah, I don't know if he's cared about societal impact, but maybe not. And that's okay. Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
Yeah, so I think, the big challenge with publishing these days is to keep up with the increased volume. The increased volume is very much related to the open access movement, which has been around now for about a good 20, 25 years. It's had a wonderful origin in trying to make a more diverse and inclusive landscape for researchers that maybe weren't in massive research institutions in Western Europe or the US, North America. And so what's happened is that a number of new journals have launched. They have some flexible pricing models. I think all publishers are really open to not charging fees to authors from the global south, for example. So we've had this huge influx of new research from new researchers that might not have been made readily available in the past. So now the challenge, though, is to curate all of that. So there are huge efforts being put by the major publishers into creating research integrity teams and developing their software platforms to have tools that can detect things like image manipulation or plagiarism, things like that. There are a lot of good actors and there are a lot of unintended mistakes, but there are, in the academic system, not the publishing system, but in the academic system, there are perverse incentives. You're not just trying to advance knowledge, let's say. You're also trying to advance your own career. And the best way to do that is through publication. The way proxies can work for academic administrators is, well, let's count out the number of papers that you've done and the number of citations. Okay, you're good. There's a qualitative aspect that really isn't accounted for in a lot of the academic system at the moment. So, I think that's the balance between the quantitative and the qualitative is, I think just a crucial discussion that needs to happen in our society, especially especially when it comes to education, amongst other things. So, so these are tools that have been developed to help, ensure that the best research from the good actors is what people see, and the bad research from the bad actors is not something that can affect the public. And one of the interesting things, the academic world, in terms of public perception, works almost the opposite from, let's say, the world of TikTok or social media. If you're, let's say, Sydney Sweeney, and something happens,
I was waiting.
Something happens that's maybe publicly embarrassing. Well, probably people are going to forget about it in 2 months, and it's not that destructive anyway. In publishing, if a bad paper gets out, it can be retracted. It can be discussed in numerous locations and news articles. But what tends to happen is people remember the initial paper and the initial communication, and that often outlives the subsequent refinement of those findings. And I think this points to there are wider public perceptions about the nature of science that need to be improved. And one of them is that it's evolutionary. Pretty much everything is provisional, and we progress through incremental findings and refinements. Like, anyone who's read Thomas Kuhn knows how these paradigms shift because you find better explanatory frameworks for existing phenomena. And maybe the previous framework was okay, but it wasn't good enough in the light of new evidence. So I think, yeah.
Yeah, sorry, go on, finish your thought.
Yeah. No, yeah. So I think this notion that research is constantly evolving and it isn't static. One study is never going to be the final truth about anything.
So at the hour mark, I think we could go so deep on some of this, and I am so passionate about some of this that, I think we should have you back on in the future to continue the discussion, because I'll just say that a lot of times nowadays when I hear people quoting statistics and using terms that no one used to use 10 years ago, and, a lot of like data science types of things and data evidence-based conclusions about anything, it kind of terrifies me, to be honest. And like in the medical space, it tells me that like data is driving the way that doctors evaluate humans and things like that, starting to speak a lot more like the people I've known for a long time. And a lot of what I've done over the years is kind of second guess, okay, what are these outliers? Sometimes they're real. And, getting all the way back to the beginning when we talked about the normal distribution, like, reality is not normally distributed. And if you ignore the tails, beware. But yeah, like just knowing we're at the hour mark and knowing that this is such a long conversation, I also did want to give some credit to our chat. Mary Manis brought up a few more movies, and one of them was Johnny Dangerously, and I figured I can actually put some quotes on here for that. But then I realized that making fun of people because of their accents and is probably inappropriate. And if I laughed when I was like 9, shame on me. But, maybe I would still recommend that to
Bill, I'm from New York.
Audience.
You never made fun of me.
Well, I guess you can probably say farting ice hole, which is...
That was pretty good. Well, yeah, that was a Saturday Night Live guy.
Joe Piscopo, who...
Piscopo.
Was, so back in the early days of Saturday Night Live, like I loved Eddie Murphy, and I would stay up when I was like 7 years old. I would stay up with my dad and my brother and watch, Buttwheat and Gumby Dammit and, Joe Piscopo. I think he was only on the show for a year or two, but it seemed like a lot longer. I remember when John Belushi died, but again, we're at the hour mark. So just in the interest of wrapping things up, Michael, can you just rattle off a few places where people can find you if they're more interested in, working with SSRN? What should they do? And this obviously comes along with my endorsement and my, again, almost trepidation that other people will find the kind of value I find. Metadata around research is valuable. Research data is, a source of ideas. And the easiest example of that would be like equity research reports and things like that. That's research, but it's also data. And then other places to find valuable information in what I'll call research data, including the whole SSRN corpus.
All right. Well, thank you so much. Thanks for this opportunity. And if anyone would like to write to me directly, please do. My email is michaelm@ssrn.com.
Excellent. Thanks, Michael.
LinkedIn and elsewhere as well, right? You're on.
Thank you, Mark and Bill. Really appreciate it. This has been a great way to spend a Wednesday afternoon. So
and people can follow both you and SSRN across LinkedIn, Twitter as well, right?
Yes. I'm just on LinkedIn, but SSRN is on X and Blue Sky, also Facebook, and LinkedIn is doing very well as well.
Okay, good to know. And we'll put that all in the show notes. Like I said, I enjoyed this enough that I know we have to continue the conversation later, but thank you very much for joining us today.
Thanks, I would love that.
Take care all.